All right, let's talk about Accuray's latest earnings. This was a report with a real split personality. On one hand, you had some solid numbers, but on the other, a bit of a miss. And all of this was happening while the company was trying to navigate some pretty serious global chaos. Okay, so let's dive right in. The good news first. On the top line, things looked pretty strong. Accuray brought in $127.5 million in revenue. That's a solid $3.7 million more than the analysts on Wall Street were expecting. A clean beat. But, and this is the other side of the coin, the bottom line didn't quite hold up. Their official profit number, the GAAP earnings per share, came in at just a single penny. That was 2 cents shy of what everyone was hoping for. So a miss where it counts. So there you have it, the classic beat and miss. And the big question is, what gives? To really get what happened here, you have to understand the absolutely wild environment Accuray was operating in this past quarter. And I mean, this was not your average run-of-the-mill quarter. Management spent a lot of time on the earnings call talking about the external shocks that really put their team to the test. Just look at this timeline. It's kind of nuts. In April, the threat of massive tariffs basically slammed the door shut on their business in China. Then, in May, those threats suddenly dialed way back, and the team had to scramble to rush products back into China. And right when they figured that out, boom, unrest in the Middle East in June shut down another huge market. Imagine trying to run a global supply chain like that. It's pure whiplash. So, what did the CEO, Suzanne Winter, have to say? Well, she was pretty direct about it. She basically said, look, the fact that we even hit our revenue goals through all of this, that was a massive win. And she gave all the credit to her teams on the ground for being so flexible. And you can see they're not just reacting anymore. They're trying to get ahead of the next crisis. They're clawing back tariff money, planning special trade zones to avoid future tariffs, and making their supply chains stronger. This isn't just about putting out fires. It's about fireproofing the business for the long haul. What's really fascinating is how all this external pressure revealed something interesting inside the company. It's almost like Accuray is operating as two totally different businesses right now, moving at two different speeds. And the numbers make it crystal clear. Product revenue, the big machine sales that get hit by shipping problems, that took an 11% nosedive compared to last year. But then look at the service revenue. It was humming along, up a steady 4%. That stable, recurring revenue was the company's shock absorber this quarter, for sure. And this isn't some tiny part of the business either. The service side now makes up 45% of all their revenue. That's huge. It gives them a really predictable foundation in a market that can swing wildly from one quarter to the next. So, they managed the operational chaos, which is impressive, but that's not all they were up to. Behind the scenes, management pulled off a major strategic move to make sure the company's financials are solid for years to come. They did a big debt refinancing. Now, you can think of it like refinancing your mortgage. They swapped their old existing debt for a brand new loan package. And why'd they do that? To buy themselves more time and a whole lot more breathing room. So what does this actually get them? Well, for one, they pushed back the deadline to repay their debt by 5 whole years. They also got a fresh infusion of cash to invest in growth, and now they only have to deal with one main lending partner. The bottom line is, this move takes a ton of financial risk off the table and lets management focus on actually running the business. All right, so that was the quarter. They weathered the storm, they strengthened the balance sheet. So what does the road ahead look like? Let's break down the guidance and give you our take on what to watch for. For the next fiscal year, they're pointing to continued growth, think mid-single digits, and better profits. But, and this is a key detail for investors, they're expecting the year to be back half-weighted. In plain English, that means most of the good news is probably coming later in the year. So patience is going to be the name of the game for the next few quarters. When you look ahead, it really feels like a tug of war. On one side, you've got some real positives pulling them forward. New products, that rock-solid service business, and the chance for a comeback in China. But on the other side, there's a big risk pulling back. And for us, the biggest red flag is the order backlog. That's their pipeline of future sales, and it's down more than 12% from last year. That's a serious warning sign for future growth. That said, not everyone on Wall Street is spooked by that risk. We saw the analysts at BTIG, for example, actually raise their price target to $5 a share. They are clearly betting that the company's strong execution and decent outlook can outweigh the concerns. So, after weighing all of that, where do we land? We're rating the stock market perform. You have to give management a ton of credit. They proved they can execute under extreme pressure, and they made a very smart move shoring up the balance sheet. But that shrinking backlog, it's a real, tangible risk to the growth story that just keeps us from being more bullish right now. And ultimately, I think it all comes down to one simple question. Has this company bought itself enough time? Can its growth strategy kick into high gear and start rebuilding that backlog before it becomes an even bigger problem? The next couple of quarters are going to be absolutely critical. This is not financial advice.